Today we're cracking open the case of SCHY, the Schwab International Dividend Equity ETF. It's a popular pick for investors seeking income and exposure outside the US market, but is it all sunshine and dividends? We'll be diving deep into SCHY, analyzing its performance compared to emerging markets, its risk profile, and that intriguing dividend focus. But before we jet set to international markets, one question burns bright: is SCHY a safe bet, or a hidden risk in disguise? Stick around, and we'll unveil the truth behind SCHY, so you can make informed decisions about your investment journey. What is SCHY ETF? SCHY, or the Schwab International Dividend Equity ETF, is an exchange-traded fund, ETF, designed to provide investors with exposure to dividend-paying stocks in developed international markets. Here's a breakdown of its key characteristics. Investment focus. Developed international markets. Unlike many emerging market ETFs, SCHY focuses on established companies from developed economies outside the United States. This could include countries like Japan, France, Germany, Canada, and Australia. Dividend-paying stocks. The fund specifically targets companies with a history of paying dividends, which can be a source of regular income for investors. Benefits. Diversification. By investing in a basket of international dividend payers, SCHY offers a way to diversify your portfolio beyond U.S. stocks and potentially reduce overall risk. Dividend income. Regular dividend payouts can provide a steady stream of income, which can be reinvested for compounding growth or used to meet ongoing financial needs. Potentially lower volatility. Developed markets tend to be less volatile than emerging markets, which can be an advantage for risk-averse investors. Cost-effective. ETFs generally have lower expense ratios compared to actively managed mutual funds. SCHY boasts a competitive expense ratio, further reducing investment costs. Things to consider. Currency fluctuations. Since SCHY holds international stocks, its value can be impacted by fluctuations in foreign exchange rates. Lower growth potential. Developed markets may offer lower growth potential compared to emerging markets, but with potentially less risk. Sector weighting. The specific sectors and companies within SCHY might not align perfectly with your overall investment strategy. Researching the fund's holdings is crucial. Tax implications. There may be tax implications associated with holding international investments, particularly when it comes to dividends. Consulting a tax advisor is recommended. How concentrated is the fund in terms of its top holdings? Here's an in-depth explanation of how concentrated SCHY is in terms of its top holdings. Concentration in SCHY. SCHY might not be the most concentrated ETF in terms of holdings, but it's important to understand the level of portfolio weight placed on its top holdings to assess potential risks and benefits. Investigating concentration. There isn't a single, universally accepted definition of concentrated for ETFs. However, some benchmarks to consider include percentage of assets in top holdings. Typically, ETFs with a significant portion of their assets, around 50% or more, concentrated in their top 10 holdings are considered more concentrated. Number of holdings. A lower total number of holdings can also indicate a more concentrated fund. Finding information on concentration. To assess SCHY's concentration, you can refer to resources like Fund Fact Sheet. The issuer of SCHY, Charles Schwab, provides a fund fact sheet that details the fund's holdings, including weightings. You can find this on Schwab's website or through your brokerage platform. Financial websites. Financial websites like Morningstar or ETF.com often display the top holdings and their weightings for ETFs. Benefits and drawbacks of concentration. Benefits. Potentially amplified returns. If the top holdings of a concentrated ETF perform well, the overall fund's return can be amplified. Lower management costs. Concentration can sometimes lead to lower expense ratios due to a simpler portfolio structure. Drawbacks. Higher volatility. A concentrated fund is more susceptible to the performance of its top holdings. If those holdings experience a downturn, the fund's value could decline more significantly compared to a more diversified ETF. Lower diversification. Concentration reduces the diversification benefit, which is a key advantage of ETFs. Applying this to SCHY. While specific concentration data for SCHY might fluctuate over time, it generally doesn't hold a majority of its assets in the top 10 holdings. This suggests a moderately concentrated portfolio compared to some other ETFs. Does the fund hold any companies with significant exposure to specific countries or regions within emerging markets? No, SCHY, Schwab International Dividend Equity ETF, does not hold any companies with significant exposure to specific countries or regions within emerging markets. Here's a breakdown why. Investment focus. SCHY focuses on developed international markets. This means it invests in established companies from countries with stable economies and financial systems, typically excluding emerging markets. These developed markets often include economies like Japan, France, Germany, Canada, and Australia. Emerging versus developed markets. Emerging markets, on the other hand, are economies that are still developing their infrastructure and industries. They can offer higher potential growth rates, but also come with greater risks due to factors like political instability, currency fluctuations, and less mature regulations. Understanding the distinction. It's crucial to differentiate between developed and emerging markets when evaluating an ETF's holdings. Here are some resources that can help. Fund Fact Sheet. The SCHY Fund Fact Sheet, available from Charles Schwab or your brokerage platform, explicitly states the fund's investment universe. It will confirm that the fund excludes emerging markets. MSCI classifications. Equity markets are often categorized by Morgan Stanley Capital International, MSCI. Their classifications clearly distinguish between developed and emerging markets. You can find this information on the MSCI website or financial data providers that reference MSCI classifications. Alternatives for emerging market exposure. If you're interested in gaining exposure to emerging markets for their potential growth, here are some alternatives to SCHY. Emerging market ETFs. Numerous ETFs focus specifically on emerging markets. These can be broad market funds or ones targeting specific regions or sectors within emerging markets. Individual stocks. You can research and invest in individual companies from emerging markets. However, this requires a deeper understanding of these markets and the associated risks. How does SCHY's weighting methodology compare to other emerging market ETFs? Since SCHY focuses on developed international markets and not emerging markets, it's not directly comparable to emerging market ETFs in terms of weighting methodology. Here's a breakdown to clarify. SCHY's investment focus. Developed markets. SCHY invests in established companies from developed economies outside the United States. Weighting methodology for developed market ETFs. There are several common weighting methodologies used for developed international market ETFs, including SCHY. Market capitalization weighting. This is the most common method. The ETF holds companies in proportion to their total market value, stock price multiplied by outstanding shares. Larger companies have a greater weighting in the fund. Equal weighting. Each holding in the ETF receives an equal weight, regardless of market capitalization. This can provide exposure to smaller and mid-cap companies alongside large caps. Fundamental weighting. The ETF assigns weights based on various fundamental factors like price-to-earnings ratio, dividends, or book value. Weighting methodologies for emerging market ETFs. Emerging market ETFs often utilize similar weighting methodologies, but some additional factors might be considered due to the inherent characteristics of these markets. Here are some examples. Market capitalization with size tilts, similar to market cap weighting, but with adjustments to give some weight to smaller companies with higher growth potential, which can be more prevalent in emerging markets. Market capitalization with liquidity screens focuses on market capitalization while also considering the trading volume of the underlying stocks to ensure adequate liquidity for the ETF itself. Free float adjusted market capitalization only considers the portion of a company's shares that are freely available for trading, excluding government or major shareholder holdings. This can be more relevant in emerging markets where government ownership can be significant. Does the fund invest in companies of all sizes within emerging markets? No, SCHY, Schwab International Dividend Equity ETF, does not invest in companies of all sizes within emerging markets for two key reasons. 1. Focus on developed markets. SCHY's primary focus is on established companies from developed economies outside the United States. These economies typically have more mature infrastructure and financial systems compared to emerging markets. 2. Emerging versus developed markets. Emerging markets, on the other hand, are economies that are still developing their industries and infrastructure. While they offer potentially higher growth rates, they also come with greater risks due to factors like political instability, currency fluctuations, and less mature regulations. Understanding the distinction. It's crucial to differentiate between developed and emerging markets when evaluating an ETF's holdings. Here are some resources to help you make this distinction. Fund Fact Sheet. The SCHY Fund Fact Sheet clearly states the fund's investment universe. It will confirm that the fund excludes emerging markets and focuses on developed international markets. You can find this document on Charles Schwab's website or through your brokerage platform. MSCI classifications. Equity markets are often categorized by Morgan Stanley Capital International, MSCI. Their classifications clearly distinguish between developed and emerging markets. You can find this information on the MSCI website or financial data providers that reference MSCI classifications. Investment options for emerging markets. If you're interested in gaining exposure to companies of all sizes within emerging markets for their potential growth, here are some alternatives to SCHY. Emerging market ETFs. Numerous ETFs specifically target emerging markets. These can be broad market funds encompassing companies of all sizes, large cap, mid cap, and small cap, or ones focusing on specific regions or sectors within emerging markets. Individual stocks. You can research and invest in individual companies from emerging markets. However, this approach requires a deeper understanding of these markets and the associated risks. How has SCHY performed during different market cycles? Here's an in-depth explanation of how SCHY, Schwab International Dividend Equity ETF, has performed during different market cycles. Understanding market cycles. Market cycles refer to the repeated ups and downs of the overall stock market over time. These cycles typically consist of 4 phases. Expansion. The economy strengthens, leading to rising stock prices. Peak. The market reaches its highest point before a correction. Contraction. Bear market. Stock prices decline as the economy weakens. Trough. The market reaches its lowest point before a recovery. SCHY's performance. While past performance isn't a guarantee of future results, analyzing SCHY's historical performance across different market cycles can provide some insights. Expansionary periods. During economic expansions, SCHY has generally performed well, with its holdings, dividend-paying companies from developed international markets, potentially benefiting from rising profits and investor confidence. The focus on dividends can also provide a steady income stream during these times. Peak periods. At market peaks, SCHY's performance might be more subdued, as valuations may be stretched. However, its focus on dividend-paying companies could offer some stability compared to growth-oriented stocks. Contractionary periods. Bear markets, developed international markets, along with the U.S. market, can experience declines during bear markets. SCHY's value could decrease as investor sentiment weakens and companies face lower profits. However, the focus on dividend-paying stocks might offer some downside protection compared to non-dividend-paying companies. Factors affecting performance. Several factors can influence SCHY's performance across market cycles. Global economic conditions. The health of the global economy significantly impacts developed international markets. Stronger economies typically lead to better performance for SCHY. Currency fluctuations. Since SCHY holds international stocks, their value can be impacted by fluctuations in foreign exchange rates. A weakening US dollar could benefit SCHY, while a strengthening dollar could have a negative effect. Dividend yields. The overall level of dividend yields in the fund's holdings can influence its attractiveness to investors. Higher dividend yields can be more appealing during periods of market uncertainty. What is SCHY's historical volatility compared to other asset classes and emerging market ETFs? Here's an in-depth explanation of SCHY's Schwab International Dividend Equity ETF, historical volatility compared to other asset classes and emerging market ETFs. Understanding volatility. Volatility refers to the degree of variation in an investment's price over time. Higher volatility indicates larger price swings, up and down, and potentially greater risk. SCHY's volatility. Developed international markets, compared to the U.S. stock market, represented by the S&P 500, SCHY might exhibit slightly lower volatility. This is because developed international markets tend to be a bit less volatile than the U.S. market. Emerging markets, SCHY is likely to be significantly less volatile than emerging market ETFs. Emerging markets are known for their higher growth potential, but this comes with the risk of greater price fluctuations. Volatility of other asset classes. Here's a general comparison of volatility for different asset classes. High volatility, emerging markets, small-cap stocks, high-yield bonds. Medium volatility, developed international stocks, like SCHY, real estate investment trusts, REITs. Low volatility, large-cap U.S. stocks, like the S&P 500, investment-grade bonds, cash. Factors affecting volatility. Several factors can influence SCHY's volatility compared to other investments. Stock selection. The specific companies held by SCHY and their industries can impact its overall volatility. For instance, a fund heavily weighted towards utilities might be less volatile than one focused on technology stocks. Dividend focus. The presence of dividend-paying stocks can offer some stability to SCHY's price, potentially dampening volatility compared to non-dividend-paying stocks. Currency fluctuations. As SCHY holds international stocks, currency exchange rate movements can add volatility to its price. What are the primary risk factors associated with investing in emerging markets? Emerging markets offer the potential for high growth due to their rapidly developing economies. However, this growth potential comes with several significant risk factors that professional investors should carefully consider before allocating to emerging market ETFs, exchange-traded funds, or individual stocks. Here's a breakdown of the primary risk factors associated with emerging markets. Economic and political instability. Political unrest. emerging economies can be susceptible to political instability, including revolutions, coups, or social unrest. These events can disrupt businesses, damage infrastructure, and create uncertainty for investors, leading to significant market downturns. Weak institutions. Emerging markets often have less developed legal and regulatory frameworks compared to developed markets. This can lead to issues like corruption, weak property rights enforcement, and difficulty resolving business disputes. Macroeconomic volatility. Emerging economies are more prone to fluctuations in economic growth, inflation, and interest rates. These factors can significantly impact company profitability and stock prices. Currency risk. Exchange rate fluctuations. The value of investments in emerging markets is directly tied to the exchange rate between the investor's home currency and the local currency of the emerging market. Fluctuations in these exchange rates can significantly impact the return on investment. A weakening of the local currency relative to the investor's home currency can erode gains or even lead to losses. Liquidity risk. Less liquid markets. Emerging markets often have lower trading volumes compared to developed markets. This can make it difficult to buy or sell investments quickly, especially during periods of market stress. Investors might face challenges exiting their positions at a desired price. Company-specific risks. Corporate governance issues. Transparency and accountability in corporate practices can be weaker in some emerging markets. This can lead to issues like insider trading, accounting irregularities, and poor management practices, ultimately affecting company performance and investor returns. Infrastructure deficiencies. Emerging economies might have inadequate infrastructure, such as unreliable power grids or limited transportation networks. These deficiencies can hinder business operations and economic growth, impacting companies within the market. How does SCHY's expense ratio compare to other emerging market ETFs? SCHY, Schwab International Dividend Equity ETF, does not directly compete with emerging market ETFs when it comes to expense ratios because it focuses on a different asset class, developed international markets. Here's a breakdown to clarify. SCHY's investment focus. Developed international markets. SCHY invests in established companies from developed economies outside the United States. Expense ratios for developed versus emerging market ETFs. Developed market ETFs. These typically have lower expense ratios compared to emerging market ETFs. This is because developed markets are generally more efficient, with lower trading costs and readily available information. Expense ratios for developed market ETFs can range from around 0.10% to 0.40%. SCHY falls within this range, boasting a competitive expense ratio. Emerging market ETFs. Emerging markets can be less efficient, with higher trading costs and potentially more research required to manage the fund. This can lead to higher expense ratios for emerging market ETFs, typically ranging from 0.20% to 1% or even higher. Understanding expense ratios. The expense ratio is a crucial factor to consider when choosing any ETF. It represents the annual fee charged by the fund manager, expressed as a percentage of the fund's assets. A lower expense ratio translates to a higher portion of your investment returns staying within the fund, potentially leading to better long-term performance. Alternatives for emerging market exposure. If you're interested in emerging markets and their potential for higher growth, here are some options with higher expense ratios compared to SCHY. Emerging market ETFs. Numerous ETFs specifically focus on emerging markets. Explore these options if you're comfortable with the potentially higher expense ratios associated with emerging markets. What are the tax implications of investing in SCHY, particularly for international holdings? Here's an in-depth explanation of the tax implications of investing in SCHY, Schwab International Dividend Equity ETF, particularly for its international holdings. Taxation on U.S. investors. As a U.S. investor holding SCHY, you'll be subject to taxes on dividends and capital gains. Here's a breakdown. Dividends. Dividends received from SCHY can be classified as either qualified dividends or ordinary dividends. Qualified dividends, these generally receive preferential tax treatment, with tax rates similar to long-term capital gains rates. The specific rate depends on your taxable income bracket. Ordinary dividends, these are taxed at your ordinary income tax rate, which can be higher than the qualified dividend rate. To determine the type of dividend, consult the tax documentation provided by SCHY or your brokerage platform. Capital gains, profits earned from selling SCHY shares are considered capital gains. These are taxed at either the short-term or long-term capital gains rate, depending on how long you held the shares before selling. Short-term capital gains, less than 1 year, taxed at your ordinary income tax rate. Long-term capital gains, more than 1 year, typically taxed at lower rates than ordinary income, with specific rates depending on your taxable income bracket. International considerations. Foreign tax credits. SCHY may invest in companies that pay withholding taxes to foreign governments on their dividends. However, you might be eligible for foreign tax credits to offset some or all of these foreign taxes paid. Consult your tax advisor for details. Taxes can vary. Tax laws and implications can be complex and subject to change. Here's what you can do. Consult a tax advisor. For a specific understanding of your tax situation related to SCHY, consult a qualified tax advisor. They can help navigate the complexities of international dividend taxation and foreign tax credits. Review tax information. SCHY's issuer, Charles Schwab, might provide tax information resources on their website. Additionally, the IRS website offers resources on tax implications for international investments. What is the average daily trading volume of SCHY? The average daily trading volume of SCHY can be a good indicator of its liquidity, which is the ease with which you can buy or sell shares at a fair price. Here's a breakdown. Understanding trading volume. The average daily trading volume refers to the average number of shares of an ETF that are traded on a stock exchange each day. A higher average daily trading volume generally indicates a more liquid ETF. Finding SCHY's trading volume. Several resources can help you find the average daily trading volume of SCHY. Financial websites. Websites like Yahoo Finance, Google Finance, or Morningstar often display the average daily trading volume for ETFs, including SCHY. You can typically find this information on the quote page for SCHY. Brokerage platform. Your brokerage platform might also display the average daily trading volume for ETFs you hold or are considering. Schwab website. Charles Schwab, the issuer of SCHY, might provide information on the ETF's trading volume on their website. Interpreting trading volume. The average daily trading volume can be a helpful metric, but it's important to consider it in context. Comparison to similar ETFs. Compare SCHY's average daily trading volume to other developed international market ETFs. This can provide a sense of its relative liquidity within this category. Trading frequency. Consider your trading frequency. If you plan to trade SCHY frequently, a higher average daily trading volume is generally preferable. Bid-ask spread. The bid-ask spread refers to the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask, for a share. A lower bid-ask spread, along with a high trading volume, indicates a more liquid ETF. Trading volume and liquidity. A high average daily trading volume typically suggests that you can buy or sell SCHY shares at a fair price with minimal impact on the price due to your order. However, even with a high average daily trading volume, there could be periods of lower liquidity, especially during market downturns. Are there any potential liquidity risks associated with investing in SCHY, especially during periods of market stress? Yes, there are potential liquidity risks associated with investing in SCHY, especially during periods of market stress. While SCHY generally boasts good liquidity, certain conditions can make it more challenging to buy or sell shares at a desired price. Here's a breakdown of the potential liquidity risks and how they might be amplified during market stress. Understanding liquidity risk. Liquidity risk refers to the difficulty of quickly buying or selling an investment at a fair price. In the context of ETFs, it relates to the ease with which you can trade your ETF shares on an exchange. Factors affecting SCHY's liquidity. Average daily trading volume. While SCHY typically has a healthy average daily trading volume, this can decrease significantly during periods of market stress. Fewer shares being traded can make it harder to enter or exit your position at a desired price. Bid-ask spread. The bid-ask spread represents the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask, for a share. During market stress, the bid-ask spread can widen, making it more expensive to buy or sell SCHY shares. Underlying holdings. The liquidity of SCHY's underlying holdings, individual stocks in developed international markets, can also impact its overall liquidity. If these holdings become less liquid during market stress, it can be harder to efficiently buy or sell SCHY shares. Market stress and amplified risks. Heightened volatility. Periods of market stress are often characterized by increased volatility, with prices fluctuating rapidly. This can make it difficult to predict the best time to buy or sell SCHY, potentially leading to missed opportunities or unfavorable entry/exit points. Investor flight. When market sentiment turns negative, investors might rush to sell their holdings, further decreasing liquidity and potentially causing fire sales where investors are willing to accept lower prices to exit their positions quickly. Managing liquidity risk. Understand your risk tolerance. If you are uncomfortable with the potential for lower liquidity during market downturns, SCHY might not be the best fit for your investment portfolio. Consider investment horizon. A longer investment horizon can help mitigate the impact of short-term liquidity issues. If you don't need immediate access to your capital, temporary periods of lower liquidity might be less concerning. Diversification. Diversifying your portfolio across different asset classes can help reduce your overall exposure to liquidity risk. How does SCHY stack up against other popular emerging market ETFs in terms of performance, fees, and holdings? Since SCHY focuses on developed international markets and not emerging markets, directly comparing it to emerging market ETFs in terms of performance, fees, and holdings isn't entirely applicable. Here's a breakdown to clarify. Investment focus. SCHY invests in established companies from developed economies outside the United States, think Japan, France, Germany. Emerging market ETFs focus on companies in developing economies with high growth potential, think China, India, Brazil. Performance. SCHY likely offers lower volatility and potentially smoother returns compared to emerging market ETFs. Developed markets tend to be more stable, but also have lower potential growth compared to emerging markets. Emerging market ETFs can experience higher volatility with potentially larger swings in both directions. However, they also offer the chance for higher returns due to the growth potential of these economies. Fees, expense ratios. SCHY generally has a competitive expense ratio within the category of developed market ETFs, typically around 0.10% to 0.40%. Emerging market ETFs, expense ratios can be slightly higher, around 0.20% to 1% or even more, due to potentially less efficient markets and the need for more research on underlying companies. Holdings. SCHY focuses on large, well-established companies with a history of paying dividends. The holdings are typically more concentrated in developed economies with stable financial systems. Emerging market ETFs can be more diverse in terms of company size and industry exposure. They might include a mix of large-cap companies, mid-cap companies, and even smaller companies with higher growth potential but also greater risk. Can I achieve similar exposure to emerging markets through a combination of individual stocks or other ETFs? Yes, you can potentially achieve similar exposure to emerging markets by combining individual stocks or other ETFs, but it's important to understand the trade-offs involved compared to a dedicated emerging market ETF. Here's a breakdown of the approaches. Emerging market ETFs. Convenience. Emerging market ETFs offer a convenient way to gain diversified exposure to a basket of companies in emerging markets with a single investment. Professional management. The ETF is managed by professionals who research and select companies, potentially providing expertise you might not possess. Lower costs. Expense ratios of emerging market ETFs are generally lower than the fees associated with buying individual stocks due to economies of scale. Individual stocks. Customization. You have greater control over which specific companies you invest in, allowing you to target specific sectors or countries within emerging markets. Potentially higher returns. Picking winning stocks within emerging markets could lead to higher returns compared to a broad market ETF. However, this also comes with the risk of underperforming the market if you pick the wrong stocks. Other ETFs. Regional focus ETFs. Explore ETFs that focus on specific emerging market regions, such as China, India, or Latin America. This allows you to tailor your exposure to specific areas with high growth potential. Sector-specific ETFs. Consider ETFs that focus on specific sectors within emerging markets, such as technology or consumer staples. This allows you to target industries with high growth prospects within these developing economies. How does SCHY compare to developed market ETFs in terms of risk and return potential? Here's a breakdown of how SCHY, Schwab International Dividend Equity ETF, compares to other developed market ETFs in terms of risk and return potential. Risk. Generally lower volatility, compared to the overall stock market, represented by the SP 500, SCHY and developed market ETFs tend to exhibit lower volatility. Developed markets are typically more established and less prone to sudden swings in price. Geographic diversification. SCHY offers some diversification benefit by spreading your investment across multiple developed economies outside the US. This can help mitigate some risks associated with a single country's economic performance. Currency fluctuations. SCHY holds international stocks, and their value can be impacted by fluctuations in foreign exchange rates. This adds a layer of risk compared to domestic US stock ETFs. Company selection. The specific companies held by SCHY and other developed market ETFs can also influence risk. Factors like industry concentration and company size can affect the overall risk profile of the ETF. Return potential. Potentially lower growth. Developed markets are generally considered to be more mature, and their growth potential might be lower compared to emerging markets. However, they offer more stability and a history of providing consistent returns over the long term. Dividends. SCHY focuses on dividend-paying companies. While dividends can provide a steady stream of income, they can also limit the ETF's overall growth potential compared to a non-dividend paying ETF that may reinvest earnings for potentially higher future growth. Comparison to other developed market ETFs. Focus and risk. Developed market ETFs can have different focuses. Some may be broad market, covering a large range of developed economies, while others might target specific regions or sectors. These variations can influence the risk profile of the ETF. For example, a Europe-focused ETF might be more sensitive to economic conditions in that region compared to a broader developed market ETF. How does currency hedging, if any, impact the performance of SCHY? SCHY, Schwab International Dividend Equity ETF, does not employ currency hedging. Here's a breakdown of how this impacts its performance. Understanding currency hedging. Currency hedging is an investment strategy that aims to mitigate the impact of foreign exchange rate fluctuations on the value of an investment. In the context of ETFs, it involves using financial instruments like forwards, futures contracts, or options to offset potential currency movements. SCHY's unhedged approach. Exposure to currency fluctuations. Since SCHY isn't currency hedged, the value of its holdings, international stocks, can be affected by movements in foreign exchange rates. Potential benefits. A weakening US dollar can benefit SCHY's performance. When the dollar weakens, the value of foreign stocks held by SCHY increases in dollar terms. This can lead to higher returns for the ETF. Potential drawbacks. A strengthening US dollar can negatively impact SCHY's performance. When the dollar strengthens, the value of foreign stocks held by SCHY decreases in dollar terms, potentially leading to lower returns. Hedged versus unhedged ETFs. Hedged ETFs. These ETFs use currency hedging strategies to minimize the impact of foreign exchange fluctuations on their performance. This can be appealing to investors who want to focus on the underlying company's performance without the added layer of currency risk. However, hedging can also come at a cost, potentially reducing returns if the US dollar weakens significantly. Unhedged ETFs, like SCHY, these offer exposure to both the performance of the underlying companies and potential currency movements. This can be beneficial if the US dollar weakens, but also introduces additional volatility. Impact on performance. The impact of currency hedging on SCHY's performance depends on the specific movements of foreign exchange rates over time. Here are some scenarios. Weakening US dollar. If the US dollar weakens over a specific period, an unhedged SCHY might outperform a hedged alternative. Strengthening US dollar. If the US dollar strengthens over a specific period, a hedged alternative might outperform an unhedged SCHY. Limited impact. If the US dollar remains relatively stable, the impact of currency fluctuations on SCHY's performance might be minimal. Alright everyone, there you have it. We've explored the world of SCHY, the Schwab International Dividend Equity ETF. Remember, the decision to invest in SCHY depends on your individual goals and risk tolerance. Here's a quick recap. Developed markets versus emerging. SCHY focuses on established companies in developed economies, offering lower volatility than emerging markets, but potentially less growth. Fees and liquidity. SCHY boasts a competitive expense ratio and generally good liquidity, although it can be impacted during market downturns. Hedging and currency. Since SCHY is unhedged, its performance is tied to currency fluctuations. This adds a layer of risk, but also potential reward if the US dollar weakens. Individual stocks versus ETFs. Building exposure with individual stocks offers more control, but requires in-depth research. Consider a combination with SCHY for a balanced approach. No matter your choice, remember, Diversification is key. Combine SCHY with other asset classes or explore regional/sector-specific emerging market ETFs to spread your risk. Conduct your own research before investing. Understand the risks and potential rewards involved. Thanks for joining me on this exploration of SCHY. If you enjoyed this video, be sure to like and subscribe for more investment breakdowns and strategies. In the comments below, let me know what other ETFs you'd like to see analyzed.